Hi, everybody. Welcome to our second installment of our TalkIQ for spring 2020. My name is Robert Farrokhnia. I am faculty at Columbia Business and Engineering Schools. I'm also the founding executive director of our FinTech initiative, Advanced Projects and Applied Research in FinTech. I have the amazing privilege of being able to host tonight's TalkIQ with one of my heroes, Sarah Tavel at Benchmark. And as you know, TalkIQ is meant to be a kind of a cerebral conversations with thought leaders and phenomenal individuals in technology, finance, business. And our theme for this spring has been not just venture capital, looking at venture capital and venture investing from a finance perspective, but also equally important, looking at mental models and best practices, what it takes to succeed in today's world where technology is not only changing everything, but also quite moving at quite a fast clip. So without further ado, we should just dive right in. I should mention that, as always, we are having a book giveaway. So all the audience members should feel free to submit questions through the Q&A function in Zoom. I'll be monitoring them throughout, and we will weave those into my conversation with Sarah. And the best question at the end will win a book giveaway recommended by Sarah or all our speakers. Last time we had the book Why Startups Fail, and this time around Sarah recommended Range and Thinking in Bets. So keep the questions coming. So let's dive right in. So Sarah, first and foremost, thank you so much for joining us from sunny and beautiful California. I know you have a busy schedule. So we wanted to, have this kind of intimate conversation with you on a multitude of fronts. But first and foremost, I should, for those who don't know, Sarah was a philosophy major at Harvard, and yet she pursued a very successful career, both in technology, both as an investor, but also as an operator at Pinterest, being the first ever product manager at Pinterest and doing really amazing things at the company before coming back to venture. So Sarah, I'm going to ask the most obvious question. Philosophy and venture are millions of miles apart, at least on the surface. So how do you apply what you learned as a philosophy major, and more importantly, if you can share tactical lessons about the value of liberal arts education in business in general? Everyone says it's a great thing, but you actually have applied it and have made it a great career, combining these two kind of mindsets. So take us through your journey and how philosophy has been useful to your career.
Sure, no, and thank you for having me, and beyond a generous introduction. Oh gosh, when I was in college studying philosophy, there was definitely no forethought that this was going to be a great way of learning to think, or that it would be, one day, I think college kids are far more career oriented or more forward looking than I was at the time. And certainly I just gravitate to philosophy because it gave me I realized that it gave me a means or a mechanism of trying to understand the world and something that I needed. I ended up focusing on ethics specifically, and within ethics, Kantian ethics. So, but don't worry, I did not recommend the groundwork to the metaphysics of morals for everybody here. But when it's kind of one of those things that you have to with the benefit of hindsight, you see what you learned. And the thing that you really gain rigor around when you're studying the type of philosophy that I studied in particular is, there is I joke often that people kind of, when they think about philosophy, studying philosophy, it's like the study of bullshitting. Sorry, I hope I'm allowed to curse. I'm a New Yorker. And actually what it is that you learn you learn logic, deductive law. One of the classes you actually take as a philosophy major at Harvard, at least, is a logic class where you're taking a philosophical argument, breaking it down into a logical proof, and then kind of seeing how the conclusion actually follows. And when you're writing an essay, when you're writing, a kind of an argument for one of your philosophy classes, you have to have just an incredible level of intellectual rigor in making your argument and kind of writing out your argument. It's not prose. It really is as close to a computer program as you could have semantically, in a way. And you have to kind of think through, you have to push your thinking through corner cases, like, what the preempting arguments that you might have. And so it just it forces you to have a level of rigor in your thinking that was its own discipline. And when I fast forward to venture, and I would even say product, in a way, like when you're building product at a company, and I felt this at Pinterest, what you are doing when you're proposing that we should build something is its own philosophical proof. It's just that the premises that you have for your conclusion to build something is each of your premises are hypotheses on how users use a product or will use a product, and you underwrite those premises with data analysis, user research, experiments that you run. And then each product, I always felt like a product document that I wrote should be logically conclusive of whether or not we should ship something, or how do we actually figure out whether or not to ship something. And I think in venture is very much the same thing. Like in venture, when at Benchmark, we don't actually write investment memos, but at Bessemer, which I was before, and at Greylock, we did for every investment that we'd propose. And very much what you're writing when you're writing an investment memo is another type of proof. It's just that in this case, the premises are certainly underwritten by analysis of the company, the competition, the founder, but then also hypotheses that you have on what the future looks like. And I think a great investment memo is also like an investment proof, although it's actually kind of, it's a great way actually of bringing those two books in, because range, the whole idea, a big part of the idea with range, the David Epstein book, is this idea of having range in your experiences lets you kind of approach problems in different ways. And then thinking in bets is actually kind of then saying, well, there's a bunch of things that I won't synthesize here, but that also, in a way, part of how do you write an investment? How do you make an investment recommendation? It's accepting that every investment you make is probabilistic in nature, and kind of using that to create its own, for me, own premise in your investment proof. And so it's, again, it's one of those things that I with the benefit of hindsight, I feel super grateful that I ended up focusing on philosophy, but it was never an intentional thing of learning how to think,
So in that case, for students, whether engineers or MBAs who are not, who hadn't had a chance to study philosophy or hasn't been exposed to it, do you feel like there is a way we could hack our way and kind of fast track getting this kind of mindset that's useful both as an entrepreneur as also as investors and operators?
I mean, I think it is. There's a kind of a few things that I still do that I find continue to hone my level of rigor around these things. Like, actually learning in public, blogging, when you write something, the act of writing is an act of synthesizing in its best form. And we can be so lazy in our thinking. If you argue something with somebody over dinner or over drinks, whatever it may be, it's just very easy to, persuasiveness doesn't always come from the logic or the rigor in your thinking. When you write something and you really kind of try to take apart the thing that you've written and make sure that it all holds together and that there's no extra words or sentences or paragraphs. And then you submit that to your friends or the public by publishing it, I think it can be a really good mechanism for pushing your thinking and finding the flaws or holes in your thinking. And then the same thing like with whom you surround yourself with at work. Like the best people, the people who are most incentivized to push you in your thinking because you both want the same output or outcome are the people that you work with. And so just choosing, it's just one of the most important decisions you can make is the quality of the people that you work with every day.
It's interesting you say that. So on one hand, I presume you're a fan of Amazon's 6-page memo model.
Yeah.
But then, at Benchmark, you don't write investment memos. So are those more kind of oral argument type, debates about the merit of an investment? And how do you go about when there is true dissent amongst the partners? What mechanisms do you deploy to ensure that best ideas are put forth, but also the fact that the loudest would always win?
Well, it's the loudest doesn't win at Benchmark. And actually, I think the reason why we don't need memos at Benchmark is because it's an equal partnership. And there's no single person, sometimes what happens in a bigger firm is that you have A, hierarchy, and B, politics. And that creates a distortion in the actual process of evaluating an investment, because oftentimes the votes on an investment have more to do with the person who is bringing the company in to present to the group than the actual quality of the company itself. And so part of what ends up happening with memos is that you are, in a way, politicking. You're preempting the questions. You're making your argument, and trying to level the playing field by showing the quality of your thinking, but it can also lead to spin and that politicking, and just a lot of wasted effort. And at Benchmark, the incredible thing about having such a small group of people, we're 5 general partners right now, that's an equal partnership, is that there's just an incredible level of trust and affection and a lack of politics and dysfunction as a result. And so it just enables or facilitates a truth seeking that is far more efficient. And so, yeah, we talk through things, we debate things. Most importantly, perhaps we let the founder come into a group that is open-hearted in a way, and open-minded and ready to kind of hear what the founder sees as the future. And then we have a discussion about it, a debate. It's not a like go around the table and get everybody gives one positive, one negative, and then the person who's championing the investment has to respond and then try to curry favor to get the votes that they want. It's really just a debate, and there are times certainly when things are controversial, and ultimately in those moments, like, it's up for the person who brought the company in to make the final call for the most part. Like there's rarely I've been at Benchmark almost 5 years now. I haven't ever seen a company be voted down. That scenario. I actually shouldn't say that. There have been some similar companies, and then it's usually when there's something like that, then you just say, okay, I'm going to trust the wisdom of this group of people, but it's very rare.
So that's actually a perfect segue to my next question, and that is, aside from the merit of the business idea and the validation and so on, what best practices or kind of heuristics do you see time and again that the best entrepreneur exhibit as they pitch the firm, and you see that that's actually could be a good sign or good proxy for success, whether that's being able to raise money from marquee firm like Benchmark, or success in the founders actually being successful in managing all the uncertainties and all the things that come along by being an entrepreneur.
I mean, it's so many things.
Give us the top 2 or 3.
I mean, some of the things that come to mind is like, certainly you just find yourself being persuaded by somebody. They see a future that other people don't necessarily see, and make you feel like they are not only, that their future is the future, not just an illusion, but also that it is that they're the ones that are gonna make it happen. That's kind of like number one. And then number two, I would say, is like the quality of the people they've already brought around them. Assuming that, it's rarely a single person. It's usually at least another co-founder, if not some early employees. And then the third and last thing I'll say, just to keep it at 3, is, absolutely a learning mindset. Like, somebody who tries to have all the answers, that's just gonna that's gonna be a problem very quickly. But somebody who is just there as a learning machine and an animal for learning, like curious, open to feedback, wants to be pushed. Those tend to be the founders that go the distance.
And in regard to post-investment, you have been on many boards already, and you kind of do a lot of hand-holding in support of companies. So looking back at all those scenarios, the founders where you first had a good sense of their capabilities, did they all meet your expectations in the sense that, or did you have surprises along the way?
I mean, you like it's back to thinking in bets, like you when you meet a founder in the beginning stages, like I'll give Chainalysis, which is my first investment at Benchmark. It was like 2 dudes who were outside of Silicon Valley, and they had been super scrappy to build a company. And you do your best to make a guess of how someone's going to evolve, but the reality is, it's just, the pressure cooker of a startup, it's hyper growth. It's impossible to predict. It's kind of, I use an analogy sometimes of like a big company person saying they want to work at a startup. It's like somebody who's eaten bland food their entire lives and then say they want spicy food. Like, until you actually taste how spicy something can be, you have no idea what you're asking for, or what you say you want. And I think there's something that parallels that with a founder, which is like, at the end of the day, we can make our own predictions, but until they face the humbling intensity of hypergrowth, you just can't know. The Chainalysis guys have just blown me out of the water, because they're learning machines, they're aggressive, they're ambitious, they're obsessed, and that's what it takes.
So now, kind of comparing your experience as an investor to the time you were actually an operator at Pinterest, and which was a company that went through a hyper growth mode, and at the same token, at the same time, you had to deal with so many variables, everything from talent acquisition, from managing the company, new products, and so on. So you always had to, and now as an investor, you're dealing with, you're also making early stage investments, which means you're dealing with a combination of art and science. So to what extent, comparing those two experiences, an operator as an investor, do you feel that the science can be learned versus the art, which is more of a kind of a gut feeling? How do you separate those two, and how do you make decisions knowing that you'd never have all the information?
I mean, I think, thinking in bets is, I think, the right frame. Like, that's how you reduce it to a science, right? Like, which is there is this, process. You have to, I think the thing that I learned most at Bessemer, working there, is that those guys, largely was men while I was there, they are the investor, and it is, how do you reduce the investment decision-making process or the investment decision, which is art and science, as you said, And particularly, I kind of think the earlier a company is, the more art it is. And then the later it becomes, you can reduce a company basically to a few metrics that people like to talk about. But there's, what's the best process to run? To, the thinking in Beth's idea is like, you can't judge your decision by the outcome. You have to look at the process that you had, which she calls decisioning. And you have to look at the process. You have to look at the process at the time and the inputs that you had for that decision, and then accept that it's probabilistic in nature of what the outcomes are going to be. Like, you just can't actually have certainty on what the outcome is going to be. And so there's, that's very much the science of it. And then I think the art is like the things that we can't articulate consciously, which is, the feeling you have of someone. Like for me, the experience I have of a product. And those are the things that you gain from experience. And as we like to say, good experience, good experience comes from, good judgment comes from, there's something, I'm bumbling it. There's something about judgment, good judgment that comes from experience, which comes from bad judgment. Like, you have to make mistakes in order to learn, in order to be better. And that's the constant learning curve that we're on.
Well, now let's switch sides and now, kind of focus on some of the kind of a day-to-day work that you do in regard to your investment. So you specialize, you make a series of, invest in a series of type of industries, but you specialize in marketplaces as well as kind of crypto in general. So I want to dig deep into, both of them, but we start with marketplaces. Now, marketplaces matured from something that people always associate with physical products to, digital products or content. YouTube is a marketplace at the end of the day. So looking at this evolution of marketplaces, where do you think the future, we are headed into the future? Is it that it's obviously creating marketplaces is exceptionally difficult because you need to solve for both, demand and supply? So if you can, share some of the best practices you have seen in hacking that problem, which seems to be a circular problem, and the kind of evolution of marketplaces from your vantage point, in the next 3 to 10 years, let's say.
There's a lot of big questions embedded there. You'll have to reorient me just to make sure I capture it all. But so the big lessons on marketplace. Like I actually have a piece I wrote on my blog that is a great example of intellectual rigor. Like it's it's a hierarchy of marketplaces. It took me forever to write this, because the process of, it's one of those things that you think you understand something, and then you start writing it and revising and then showing it to people, and you realize, oh, I don't really understand this as well as I thought I did. And it took me, 6 or 9 months to finally get to a place where I felt like I could ship something. But so in it, I try to crystallize as much as possible the lessons that I've seen. And what I like, the biggest thing that I realized, I'm a contrarian at heart, and I always, I love to be the person who kind of sees what other, the way in which the gospel is wrong. And one of the things that I was just starting to feel, with all these founders I was being, that were building marketplaces, is that they were doing something. They were doing what I kind of refer to now as chasing GMV. They, you would have all these founders who come in and they're trying to grow as quickly as they can in order to raise venture capital. And they kind of see from the outside the Ubers, the DoorDashes, et cetera, that have these incredible ramps. But the challenge is that if you are building a marketplace to optimize for maximizing your ability to grow GMV very quickly, it actually takes you in the wrong direction. It it's one of these things it kind of feels good in the short term, but actually you end up trying to be a mile wide and an inch deep. And really, when you think about why our marketplaces just incredible businesses, if you can pull one off, what you realize is that the best marketplaces are dominant in their markets. They are not just number one in aggregate. They are number one in a specific market and dominant in that market. You know, not just like number one, you know, they have 30% market share and there's a 25% market share player and then there's a 20% and, you know, like there it's like 70%. And then there's like everybody else. And when you get to that place, that's when you have incredible strength in your network effects and therefore incredible profitability in your model. And it's just an incredibly strong moat to have. But that means in order to get there, you have to kind of start from that goal when you're building a marketplace and work backwards from there. And the working backwards actually orients you not towards chasing GMV, as I articulated before, but focusing on a super, super, super small segment. And getting this, you know, I kind of think of it as like the white hot center of a real need between the supply and the demand. And obviously you don't want that white hot center to be a dead end, but if you don't, you know, what I say is that you have to maximize happiness, not GMV. And if you get happiness right, then you're going to be able to, then the secondary effect of that is going to be GMV. And so the example I give, you know, in my blog, and tell me if you want me to shut up, I can stop going. Is kind of DoorDash versus Postmates. Postmates chase GMV. I don't know how many of you guys are Postmates customers, but they would go after the biggest markets, you know, New York City, San Francisco, DC, LA, and they went across all the categories. And it was a maximized GMV thing. You might think that they were a successful company. They sold the company for, I don't remember, $1.something billion, but they raised like $1.something billion in order to do that. DoorDash took a completely different approach where they actually went after the suburbs where there was no competition. It was easy to get to, you know, a very high percentage of the market very quickly and like have real liquidity. And then they were able to kind of go from that position of strength into the cities and dominate. So it's kind of interesting to see those two things. What's the future? The future.
Hang on, hold on. Let me just cut you off for a second. So this Postmate versus DoorDash, I think, is a phenomenal case study. But do you feel like, you know, DoorDash went about this exercise methodically and applying the intellectual rigor, which is kind of interconnecting issue of our conversation and a lot of things that you do? Or did it come about just by happenstance, that the fact that they said, well, we can't compete in the big market, let's just go for the smaller market, not realizing that they're actually hitting on goal?
No, I think it was a very intentional thing by them. I think Tony has talked about it. It's very intentional of like just recognizing that there's like this green field that no one, you know, let's prove out the model in these suburbs where there isn't competition and it's a delivery desert. And if we can prove it out there, then we'll be able to take the model into the more competitive places. I don't know if he would have predicted that it would be as successful as it is today. I mean, it's hard to predict something like that, but it was absolutely an intentional thing. And it makes sense. Like Postmates, when they went after San Francisco, there was already Grubhub. There was already, you know, there were already like these restaurants having their own delivery fleets. Like the competitive dynamic was very different from the very beginning than what DoorDash had. And so it was to think you could find a greenfield you wouldn't think that there's a greenfield opportunity in food delivery, but there was. There still are. Like I still get pitches from startups that are going after colleges or going after 100-mile radius or whatever. Like there's still people that are iterating on these types of models, but at the time no one thought it was possible to build a food delivery company in the suburbs.
So it goes to show the value of intellectual rigor in your
Yes.
analysis. Now the next part is kind of future, the evolution of marketplaces. Where do you see them headed in the next 3 to 10 years, let's say?
Yeah, if I had that crystal ball, you would be dialing. I would be dialing in from my island.
And you have donated to Colombia a big sum.
Yes, yeah. I mean, look, like I do think I'm incredibly excited about everything happening in Web3, and if you think about it, I don't know if this is the 80% case. But most new consumer experiences, and I include marketplaces within consumer, are usually catalyzed by some kind of technological change. And so, Uber, what was Uber, DoorDash were really facilitated by the mobile phone and GPS. And the current technological catalyst that we have right now is a blockchain. And kind of all the other underlying protocols that people are building. And what does that facilitate? It facilitates digital ownership, digital scarcity, an economy that you can kind of trade for US dollars or whatever your local fiat is. It kind of can align incentives of those early users to enable, to make your network successful. And so there's something there that is, I think, we're at the very, very beginning of seeing what are the new experiences, the new marketplaces. OpenSea obviously is the topic du jour now, but there's going to be so many things that get created from that, I believe. And so I just believe we're going to see a ton of innovation on these digital assets and just broadly what crypto enables. And so I hope, well, it remains to be seen how that all evolves. There's certainly other areas, like I'm on the board of a labor marketplace in the healthcare space that's doing phenomenally well. And I think, you're going to just continue to see a change in our labor force and how people work that I believe will likely be facilitated by different types of marketplaces. So it's all these things are still evolving.
Now, in regard to your investment thesis around crypto, you've been quite methodical about it. But can you kind of share your high level thinking about crypto? Because most of the use cases we see thus far, up until recently, they have been mostly speculative as opposed to consumptive. But now we are, as this evolution is happening and you're seeing more and more innovation, certain areas are emerging as more promising than others. So I'm curious to know from your perspective, what kind of thematic investment opportunities do you see in crypto, and including, NFTs and DeFi?
I mean, I think we're still very early days here. So I'm still a believer that there's a lot of work to be done on the picks and shovels and infrastructure in order to facilitate this ecosystem. I just tweeted today, the wallets that exist right now, I think are skeuomorphic. I think we're still in this transitional era of crypto that is intimidating, that is dangerous. There's so many scams happening. That is probably insular. I think so much of crypto thus far has played to the people who are already crypto rich, and they're bringing their own crypto and spending, a lot of ETH on something where if you think about buying it as you and me with a credit card, you would never think to spend up, several $100,000 on a JPEG, as people cynically say. But if your cost basis in ETH is de minimis, then it's actually not really that much of a cost, but it creates this gulf between the people who are early in crypto and the people who are new to crypto. And we're going to have to, cross that, because you can't, you have to, what's the point if you have 25 million people who use crypto, right? There's just, that's not that's not what everybody's building towards. So we need the infrastructure in order to facilitate that kind of crossing to the Gulf. And there's a lot of different things that we could brainstorm there. But then it's too, what are the consumer experiences that end up being something that is not intimidating for consumers? But the way I think of it is like, they call it Web 3, not crypto 2.0. Web 3 is an evolution of Web 2. It's, except now, like, just like, to the mobile phone analogy I gave before, like when mobile came out, then we had GPS and we had a camera, and there were so many new consumer experiences that we could create. Now we've got a blockchain, and we've got, NFTs. Like I'm profoundly excited and motivated and stimulated by what's possible with NFTs. I think we're still in the skeuomorphic era of what we even think of for NFTs. But so these new primitives are like a new palette for consumer builders to come and create companies. And I'm just super excited to see what becomes of it.
So do you see evolution of crypto morphing more, kind of toward more consumer use cases simultaneously along enterprise? Or do you feel like enterprise is going to need to come first, such that the infrastructure would be, be put together and eventually kind of see the same kind of a mirror image of how, internet itself came to be?
Yeah, I mean, I'll confess, I'm not somebody who's like DeFi. I get, somebody writes me an email about a DeFi company, and like, I don't take the meeting because it's not my world. What is my world is creating consumer experiences. And by the way, we need that world. Like, what's the point of protocols or this underlying infrastructure if there's no demand? Like, in a way, you think about the supply side here is these protocols and all, the blockchain and everything, but you need the demand side, which is the use cases on top, to create usage for all of the great things that people are building. And so that comes from consumer. And so I think we absolutely need to have these experiences. What's not clear to me at this point is whether we've yet assembled all the infrastructure components to enable the consumer use cases that will actually be, mass market consumer.
So as you can imagine, there's a lot of excitement and a lot of activity by our students around, blockchain crypto domain. And the question I get, all the time is that, Professor, should I join a, crypto startup now, or should I wait a few more years for this to mature a bit more? There's a lot of risk. So the question I'm going to pose for you on behalf of our students is, what do you think about this question? There's, as we have students who are carrying a fairly big, student loan, and they're worried about the viability of entire ecosystem, and whether it's just going to be more of a longer-term fluke as opposed to this hyper growth that are being, discussed. So where do you stand on that question?
Yeah, I think you're running a, well, I can't, for people who have loans, like I can't, everybody has different risk tolerance. And so it's hard to know, and there's no question that crypto is more on the risk-loving gambling side of things right now than, joining a software company or a consulting company or something like that. So it is absolutely on a higher risk side. Now, there's also the question, I always think about things as like, you have to, if you can't optimize for the step right in front of you, you're optimizing for the arc of your career. And over the arc of your career, you want to be surrounded. The first tours of duty that you do, the first, I would even say tour, but it's really kind of the first 1 or 2 tours of duty where I'm thinking, kind of 4-year type job, plus or minus a little bit. You want to maximize for your learning and the people that you're surrounding yourself with. And then, ideally, like, if I had started off doing biotech, my first job out of college was actually in healthcare, funny enough, but like if I had at Bessemer focused on biotech, like my career would have taken a completely different trajectory. And so I think that if I look at what's happening in crypto, I think many of the smartest people, the most curious people that I know can't help but feel a magnetic pull towards crypto. Also, many of the most skeptical people I know think it is just a casino and nothing's going to come of it. So you have to, that's where the risk tolerance comes in. But like if you're maximizing for learning, it's a crazy, changing, dynamic space right now where you'll be exposed to a lot of brilliant people. And if it is right, if it is actually the future of the internet, which many, including myself, believe, I wouldn't say it's future of the internet, but like without question, kind of the next wave, then you are maximizing, by starting now, you're maximizing your optionality for the future.
So it's not too late yet.
Oh, it's so early. It's so early. When I started digging back in kind of Q4 2020, and I got panicked because I thought maybe I was too late. And then I just realized, holy cow, it is still so early. And there's so much noise right now. When that noise dies down, which it inevitably will, we'll all realize how early it still is.
Great. So I'm going to come back to crypto a little bit later and include more of audience questions. But before, since you were talking about, we're talking about student careers, you're talking about the importance of the first, few tours of duty, as you put it forth. Looking from your vantage point and looking at the realities of the world today, what advice would you share with our students in regard to really optimizing their career growth in line of taking into account all this fast-paced change in technology and all the new things we need to learn? I always say, long gone are the days we give you a degree and the thing that you learn will carry you for your entire career. Now, what we teach you at best gets your foot in the door, and then you have to, have the self-discipline to learn more and more. So what characteristics, what kind of mental models, mindsets do you advocate for students to apply and learn that you feel like would be definitely beneficial for their career growth and kind of navigating all these, choppy waters that come to be from time to time?
This is such a personal question. Like for me, like what did I do? I worked harder than everybody else. And like that's not for everyone. But like you work really hard wherever you are, you're just maximizing that opportunity and things will come to you. And so I think there's like a level of grit that I'm a big advocate for. I don't know anything hard that gets accomplished by not working really hard, honestly. And this is where I am definitely I feel like I'm an older generation. And then it's the things I already articulated. I don't know if I have anything else to add. The maximizing for learning, maximizing for the people that you surround yourself, maximizing for you. It's in the same way that a founder, there's one of our founding partners of Benchmark talks about a great team meets a bad market, the market keeps its reputation. Doesn't matter how good you are. If you're going into a stagnant field, like there's only so much you can do. Same thing with like a big company. If you're going into a big company, like guess what? Like you think you're gonna I would interview product managers from Microsoft when I was at Pinterest, and they would be there for like 8 years. And I felt like they would learn as much in those 8 years as I had learned in a quarter at Pinterest, because you get like this thin slice of product that you get to own. It takes forever to do anything versus like the craziness of a company. And so maximizing, I have a blog post on this that like you can't just optimize for a learning curve. You have to optimize for a learning cycle, which is how quickly the job you have you can learn there, how quickly the feedback loop is. And so, finding a field that, again, like I got lucky getting into venture capital. It wasn't there wasn't a lot of forethought until I heard about VC, and then I read about it and I was like, this sounds fascinating, I want to do this. And it ended up being in technology, and that's like an amazing wind in my sails. And so really, really optimizing for that, I think, has a huge difference in the overall trajectory.
All right, so now that's actually a perfect segue for two audience questions I wanted to ask. So one is that you had worked at three of the best VC funds that there is: Bessemer, Greylock, and Benchmark. Now, what is from each of those firms, if you could share one best practice, whether it's from a culture, especially from a culture perspective, or others, that you feel has been unique and very helpful in ensuring that we can cut through the bias and get to the core of the issue without politics and so on and so forth.
I mean, Bessemer, there's two things I'd say. One is the actual practice of investing that I kind of articulated before. They have a scenario analysis that they do, and it's very much like thinking about risk-adjusted returns and what's the right risk to take, and in a process, they have an incredible process there around that helps maximize their chances of making great investments. And the second thing that I would say about Bessemer is that it's very much a mentorship model. And it is, one of the few places that will bring somebody a year out of college, which was, for me, that's when I started, and mentor them and have them go, up rungs of the ladder so that, mold them as an investor, as a Bessemer investor. So I think that's just an incredibly powerful thing to do. And I just got so lucky to have had that be my first tour of duty. At Greylock, the thing that I really appreciate and took, and this is primarily from Reid Hoffman and I would say David C., is the orientation around network effects and how, the companies that really, at least on the consumer side, are able to, be behind the outcomes that we all dream of as investors. Those are companies that have network effects. And so that's a huge thing. At Benchmark, I'm biased. There's like 50,000 things that I could say. One of the things that I think we're real students of is what the best companies look like as public companies. That's companies that scale, and then working backwards from there. And definitely an orientation that, you can, as my partner Bill says, you can only lose one times your money. And so being very oriented towards what can go right, kind of cultivating that optimism is incredibly important. When I invested in Chainalysis, you could have asked, this was like 5 years ago, who knew what was going to happen with crypto? And you could have thought that it would be a small opportunity. But if you ask the question, what could go right, and you kind of go down the thought process of what's possible with crypto and what, how big that could be, you start to be able to see the possibility, again, in that scenario analysis where it is probabilistic, but that possibility of something really, really big.
Obviously, a benchmark is this privilege of the name, and the fact that most likely, a lot of good entrepreneurs aspire to be funded by Benchmark. By the same token, you guys are quite actively looking for, sourcing opportunities. The question is, what process do you deploy in sourcing investment opportunities from companies seeking growth capital, or seed investments, for that matter?
We don't do seed investments, but like what I think of my framework is I think when you're sourcing, we don't have, first of all, we don't have a machine. So, there's some firms that have thrown bodies at this problem. They have dozens and dozens of junior people who are doing a lot of the works, like kind of what I did at Bessemer. At Benchmark, we don't have that model. It's very much driven by the GPs. And I think that the way that you make, I know, and by the way, I would say that it's actually the Achilles, every strength has a corresponding weakness. And all the strengths that Benchmark has, I would say that the corresponding weakness is certainly our coverage. Like we are 5 people, and Andreessen is 250 people, whatever it is. Like it's just a very different equation of how many companies we can meet with in a week versus a company that has hundreds, a firm that has dozens, if not hundreds of people. And the way that I, then kind of play is I think, I have to have what I would think of as an air game and a ground game. The air game, things like blogging, tweeting, today I tweeted about, I would love, some kind of idea I have. And it's a one-to-many way of doing things that lets people kind of, reminds people of where you are, but more importantly, lets people know when they should think of you. My sourcing of marketplace companies went up significantly after I published my piece on the hierarchy of marketplaces. So, podcasts is another way of doing things, but that's kind of air game. And then the ground game are the things that we, is the grind. I called email chain analysis. Meet with seed investors, angel investors, going to dinners, reading a lot, Twitter, everything else. So that's kind of the hustle that is required in a way to source opportunities.
That's the hard work you were referring to earlier in the comments. Yeah. Now, speaking of marketplaces and crypto, do you believe that Ethereum has shown to be the dominant player, or is it that's still way too early to kind of see which company would end up being the backbone or the dominant player in Web 3.0?
I don't know if it's well, first of all, the Bitcoin maximalists in the audience, I hope, are going to throw a rock at the screen and send you some angry notes. Look, Ethereum, it's still so early, and like what you could, it's funny, like when I started to kind of remember beginning of last year, I started to look at some kind of other layer 1 blockchains, Solana, some side chains, Polygon. And I remember I emailed like a bunch of my smartest friends in these crypto native firms, and they all, told me, oh no, Ethereum, the network effect of Ethereum is way too strong, and there's no chance another layer 1 is going to emerge. And then you fast forward 6 months, and Solana grows like crazy. Ethereum gas costs are obscene. The layer 2 companies are interesting, but most of them were not yet ready for prime time. And everybody's like, oh, it's a multi-chain world. Now, and so it's just like no one has a crystal ball. There's so many moving pieces in crypto right now that I think humility is the best course. If you put a gun to my head and said I had to answer, what I would say is I do think what's going to end up happening is some kind of use case bifurcation. There's somebody wrote a blog post that I thought was a great articulation, which was that think about each blockchain as its own city. And you have New York City, you have LA, you have Boston, and like these cities have different modalities and different centers of excellence. And certainly you could see that happening in crypto. Like as an example, Ethereum is, outside of Bitcoin, the most decentralized and that's kind of a trade for security. And so if you're doing DeFi transactions, you'd rather them be on Ethereum than on another chain that's either, that's not as secure or not as reliable. Like Solana, is fast and cheap, but it has downtime. There's, drop transactions. But if you're a gaming developer and you want people to be able to mint NFTs, you don't want to spend you don't want your users to spend $100 minting an NFT, which is what you would have to be, call it $15 to $150 on Ethereum for the gas costs. And so it would make sense that a lot of gaming activity ends up gravitating towards this chain like Solana. But Solana has to do a lot of things to keep up with demand right now too. And so, assuming phenomenal execution on these chains, then I think we'll end up having a multi-chain world. But there's so many moving parts right now.
What are your thoughts on DAOs? Do you feel like they're gonna, in eventuality, would lead them to be kind of a specialized tool, or do you see more use cases on a broader basis, including on the consumer side of things?
I think DAOs are, it's going through the Gartner hype cycle, right? So in the beginning of the peak of it, we're probably still ascending into the peak of inflated expectations. And people are moving out. I find that there's some founders and they almost treat decentralization as the race that they're running, like that decentralization is the whole point, and DAOs is like the latest manifestation of that. But if you ask me what my worst nightmare would have been building product at Pinterest, it would be building it via DAO. It just sounds horrific. But there are some things for which it makes a ton of sense. I think the Constitution DAO, even though it didn't work, was a great example of a very narrow use case for something that was a great, use case there. There's obviously going to be, for a lot of these DeFi and protocol level projects, they have no choice but to go decentralized because of regulatory pressure, and a DAO then becomes a mechanism by which they organize. But it's not something, I feel like we're gonna have to go through that crash of recognizing whoa, it's a really inefficient, hard way to organize people. As powerful, it is incredibly powerful, but pick your use case, because I wouldn't want to build product via DAO.
Now,
consumer-facing product.
A related question around governance in crypto in general. I mean, obviously, you see a lot of conversations, and a lot of people talk about, oh, this is truly distributed, decentralized, governance structure. But at the end of the day, it's not that. It's either at best is a combination, or sometimes it's kind of centralized disguised as decentralized. So in terms of how governance is going to evolve, what are your thoughts about the kind of use case? You mentioned you kind of made your views clear on DAOs, but do you feel like governance in crypto in general is going to suffer as a result, or is it always going to be kind of a mixture of centralized and decentralized, and people will pick which flavor they like and which ecosystem they want to play in?
My hypothesis is that we're going to have two cultures in crypto, two worlds in crypto. There's going to be the crypto native DeFi protocol level work that's going to be very decentralized, and that's the whole point. But then you're going to have what I believe is going to be a hybrid world of centralized companies like SoRare that we're investors in, Axie Infinity, like OpenSea, those types of companies that are actually centralized entities, a Coinbase, but then built on a decentralized infrastructure. And that's what I think to be Web3. And that's what I spend the most time thinking about. Those are the companies I'm most interested in.
We have only a minute or two, and I have only 200 or 300 questions to ask you, so we limit ourselves to only one, and that is, to what extent are you a believer that data analysis and the likes will be helpful as you go about sourcing and looking at investment merit of an idea? That is, how much of what you do can be quantified into algorithms and data, and how much of it will always remain an art, leveraging all the heuristics and all the personal experience?
For our stuff, we're early stage investors. The best you can do is know that have some kind of signal on great founders, or companies that have great seed and early stage investors, and hope that surfaces things up. But at the later stages, it's kind of like a the very extreme is a public equity analyst that could almost, who could probably do a pretty good job just with an algorithm.
Well, Sarah, thank you so much for your time. I know we are at the top of the hour, and you have a very busy schedule, so we certainly appreciate you giving us an hour of your very valuable time. And in regard to the winner of the book, we had a lot of good questions. So I'm going to email the winner separately once I had a chance to go through the list once again. But we thank you for your participation. Certainly look for our next event on the 3rd of March, same time, with Dana Grayson from Construct Capital. And we look forward to seeing you at our next event. Sarah, thanks again. Wishing you a lovely day. Thank you, everybody.
Thanks, everybody. Bye.